So last week in the second half, we discussed about fixed income securities. We just started to discuss fixed income securities. Today we continue with that. Just to recap what we discussed in the fixed income. First, we discussed what is a fixed income security. Fixed income security is an obligation of a borrower to pay a fixed amount on a specified date. There may be interim fixed cash flows in specified intervals. Then we discuss about few terms. First thing we discuss issuer, then the investor. Issuer is the party who borrows money. Investor is the party who lend money to the issuer. Then we discuss about maturity. That is the time period. That's the time period of the life of the fixed income security or the bond, and the maturity date that's the date where the borrower or the issuer promised to pay back and cease to exist this instrument. Apart from that, this is with regard to dates. Then we discuss coupon dates. Before we discuss coupon date, we have to discuss about a coupon. What is a coupon? Coupon is the interest that the issuer agrees to pay on a periodic basis. It may be annually, partly, or semi-annually, or maybe monthly. The rate which is used to calculate this coupon is called coupon rate. So the coupon rate and coupon. This is the rate that we use to calculate the coupon amount. So this is a percentage, coupon rate is a percentage, and the coupon is an per rupee or dollar amount. The coupon will be paid on the coupon date. Coupon date will be decided based on the frequency that the borrower or the issuer agrees to pay interest. Interest is calculated based on the face value. What is face value? That is the principal amount that the borrower or the issuer of the fixed income security agreed to pay on the maturity date. That's the amount the borrower agrees to pay on the maturity date. We call it face value or principal or redemption value. Sometimes we call it maturity value or maturity proceeds. So all these are referred to the amount the borrower agrees to pay on the maturity date. So the coupon is calculated. Coupon amount is calculated based on the face value into coupon rate. That's a percentage, and generally coupon rate is expressed as a annualized figure, annual interest rate. So therefore, if the frequency is not annual, we have to multiply it by that factor 1 over f. F is the frequency of the coupon payment. So we discussed all these concepts last week. Then we discussed about trade date and the settlement date. So this is general concept. We discussed trade date and settlement date or the value date concept in FX as well. The same is true here, but it's not T+2 necessarily. That depends on the market and the country and the instrument. Depending on the instrument type and the country and the currency, the difference between trade date and settlement date may vary. Then we discuss another concept called accrued interest. What is the accrued interest? A bond can be traded at any time once it is issued. So settlement date can fall on in between any coupon dates. This is the last coupon date. Now this coupon is already been paid and this is due. But the settlement date may fall somewhere in between that. In between the two coupon dates. Accrued interest is the interest accrued on this bond for the period from the last coupon date to settlement date. That is the accrued interest. If somebody holds for the whole full coupon period, that bondholder will get the full coupon amount. But if you trade it in between, the previous issuer or the seller of the bond is entitled to get interest for this period. What is this period? From the last coupon date to settlement date. Then the buyer is entitled for the interest only for this period. But on the coupon date, issuer will pay coupon to the current holder. Therefore, this buyer will get the full coupon amount for this period. Therefore, when the buyer buys it in between to coupon date, the buyer has to pay whatever the accrued interest up to this settlement date. So at the time of buying, the buyer will pay that accrued interest component to the seller. So that part we call accrued interest. We will discuss today how to calculate this accrued interest. So this is the summary what we discussed so far. Do you have any questions? Do you have any questions?
Dirty price and clean price are come into play in this situation. Like
Yes, yes. Yes, we discussed that one as well. Dirty price is the clean price plus accrued interest. So generally, we agreed to buy at this price, and we add that accrued interest component, then calculate the dirty price. This is the total amount that we have to, as the buyer, has to pay to the seller. So clean price is the price without accrued interest component. Dirty price is the price that we have to pay to the seller with the accrued interest component. The thing is, on the next coupon date, whatever this accrued interest component, you get it back as the coupon, part of the coupon. You get the full coupon if you hold it until the next coupon date. You get this full coupon. That means whatever the amount that you paid as the accrued interest to the seller, you get it back. So indeed, to buy the bond, you have paid only this amount. Any other question? So we discussed this coupon amount, accrued interest, bullet maturity. Today we discuss from this point and onwards. First we will discuss about how to price a bond. How do you calculate the price of a bond? Any financial instrument, the price, the basic concept of pricing is the value of that security or financial instrument is the present value of future cash flows. That is the basic principle. So price is the present value of future cash flows. This is the basic concept. If you have to value most of the financial instruments, it may be a stock or a bond. This is the basic concept. So this is applicable for a fixed income security or a bond as well. So therefore, to calculate the present value of future cash flows, not only one cash flow in a bond, now you know there are many cash flows. To calculate the present value of, consider just one single cash flow. To calculate the present value, what are the things that you should know? What are the things that you should know to calculate the present value of a future cash flow? Consider just one cash flow in future.
Face value and coupon interest.
Face value and
coupon interest.
Face value. What do you mean by face value here? It is not, when I forget about this bond, now just consider just a cash flow in future, single cash flow. What you should know? Face value, I know.
Maturity.
What you are referring to?
Maturity.
What is the
maturity?
Maturity. That means when do you expect that cash flow?
Yes.
That is the time. Correct? Whether it's you get it in 1 year time, 6 months time, or 10 years time. You need to know timing. What else?
Coupon rate.
What is the amount that you are going to receive? To calculate the present value of a cash flow, but one thing you need to know, when are you going to receive that? When? So timing. Then the other factor, what is the amount of that cash flow that you are going to receive in future? What else you need?
Coupon rate.
Is it the coupon rate? The coupon rate is applicable only for a bond. It's not assume it's not a bond. I'm referring to just a single cash flow, whatever it is in general. That is the
Interest rate.
rate of return, or you can simply say interest rate applicable for this time period. Correct? What is the equation to calculate the present value? That is the future value divided by 1 plus r to the power n. R is the interest rate or the required rate of return. N is the number of periods. That is timing. FV, future value, that is the amount of the cash flow. Clear? So we need these things to calculate the present value of a single cash flow. Now in a bond, is it a single cash flow? No. In a bond, there is a series of cash flows. So therefore, what we have to do first, we have to decide what are the amounts that we are going to receive and when are we going to receive these cash flows. That's the first thing that we have to do to calculate the price of a fixed income security. What are the cash flows? Now, to make it simple, we'll assume there's a bond with annual coupon. Then, and assume 5-year maturity. How many cash flows? Annual coupon bond with a 5-year maturity. How many cash flows? Every year you will get the coupon, and on the maturity date you get coupon amount plus the face value. So there will be 5 time periods in years. Year 1, year 2, year 3, year 4, year 5. What do you get? Coupon, 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 coupon. But on the last payment date, you get coupon plus face value. It doesn't matter whether you consider these as 2 cash flows or the sum of the coupon and the face value as a single cash flow. Either way, you can do that. So if you know these, that's the first step. You should be able to identify what timing, exact timing of the cash flows, and the amount of cash flows. Remember, on the maturity date, coupon plus face value, not only the face value. Then what do? You need one more thing. That is the required rate of return. In simple, you can say it as the interest rate. As a banker, if you grant a loan to a customer for a 5-year period, you charge some interest. That is your required rate of return. That may vary depending on several factors. If you lend some amount to the government for a 5-year period, what is the interest that you charge? And if you lend the same amount to a corporate client, what is the interest rate that you charge? And if you lend the same amount for a 5-year period again for a small enterprise, SME sector, what is the interest rate charge? Or if you grant a personal loan, what would be the interest rate that you charge? That varies. That depends on several factors. For the same period, it may be the credit quality of the borrower. Depending on that, you add some premiums. For different tenors, depending on your liquidity, term premium, for different tenors, you charge different interest rates. So therefore, first thing you have to decide then what is the required rate of return for this particular bond. Once you decide, assume that's R, the required rate of return is R. Now you have all inputs to calculate the present value of each and every cash flow. What do you have to do? Since we assume this, I'll denote this coupon payment as C. All coupons are same. What is the present value of this first coupon? If the required rate of return is R. Coupon amount divided by 1 plus R. What is the present value of the second cash flow? The amount is the same, C, but divide by 1 plus R to the power 2. Correct? To make use the space properly, this is cash flows. These are present values. Present value of this cash flow, C over 1 plus R. Present value of the second cash flow, that means the coupon that you receive in 2 years' time, C over 1 plus R to the power 2. Present value of the third cash flow, the coupon that you are going to receive at the end of the 3-year period, coupon divided by 1 plus R to the power 3. Fourth one, C 1 plus R to the power 4. The last one, you can consider both as a one cash flow, or you can break it into 2. But still, the denominator is 1 plus R to the power Fine. Then what is the present value of all cash flows? This is the present value of coupon that you are going to receive at the end of the first year. This is the present value of the coupon that you are going to receive at the end of the second year, likewise. What is the present value of all these cash flows? That is the sum of all these present values. This is the present value of all these cash flows. This present value is the price of the bond. Clear? So here I took an example of a 5-year, but now you can generalize it up to any number of years. That is the equation given in the slides presentation. If you go to slide number 19, there's an equation. That is the equation, a generic equation to calculate the price of a bond. R is the required rate of return. C1, C2, C3, and Cn are the cash flows. C1 means the cash flows at the end of first period. C2 is the cash flow at the end of second period, likewise. Cn means we assume there are n number of periods. At the end of n periods, you get the coupon and the face value. So either you can write it as two separate component in this equation, or as I wrote it on the board as a one component. Is it clear?
Yes, sir.
So even though I have put C1, C2, C3, Cn to make it more generic for a fixed coupon rate bond, that means during the lifetime there's no change to the coupon rate. The cash flow, all cash flows, meaning that all coupons would be the same amount. So then what is this equation? The same thing, but as I mentioned, if all coupons are same, you can consider up to this only the coupon payments as an annuity. What is an annuity? You get certain amount during specified time periods, time intervals, same cash flow, same amount in regular time intervals. Then what is the present value of that cash flow? The first part of this equation is that when we discuss about annuity, instead of C, we use the letter A here. R is the interest rate, N is the number of payments. So this part is the present value of all coupon payments using that annuity equation. Then the second part of the equation, in the right hand side, is the present value of the face value that you receive at the end of n periods. The first part is the present value of all coupons, and the second part is the present value of the face value that you receive at the end of n number of periods. So this is first part is coming from the annuity equation. Instead of this series, you can consider when all coupons are same amount, this cash flow series as an annuity. Then you know how to calculate the present value of an annuity. This first part is that. The second part is the present value of the face value. Because this is easy. Assume you get a bond of 20 years, or no need, 10-year bond with semi-annual coupon. How many cash flows? 10-year bond with semi-annual coupons. How many cash flows you will get? You get 20 cash flows. Why? Every 6 months there's a coupon payment. Every 6 months there's a coupon. So if you have to use this equation, you have to calculate 21 cash flows and calculate the present value of all these 21 cash flows. It is a difficult task, but when you use this equation, it is simple and it is easy to do that. So therefore, this is the concept behind the valuation of a bond, and this equation you can use to value a bond easily. If you are clear about that, I'll switch into another example. The one I discuss is with annual, and this R is required rate of return, but annual. R is the required rate of return, annual. You quote it as an annual rate. What would happen if the coupons are paid semi-annual? Now we'll take a 2-year bond to make it easy, and coupon semi-annual payment, coupon frequency. How many cash flows? Now we cannot count periods in years. Why? Coupons are paid in semi-annual. So therefore now we count periods semi-annual periods. Now you can't say E equals 1 is 1 year. It is half a year, 6-month period. And E equals to, this is 0.5 years. When we say T equals 2, this is 1 year, then 1.5 years. This is the third period, and the fourth period is 2 years, and T equals 4. Here there are 4 cash flows. There are 4 cash flows. Coupon, 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 coupon plus face value. Now what do you do? The R, still the required rate of return, is quoted in annual terms. Now to calculate the present value, instead of R, we use R divided by 2. To calculate the present value of the second coupon, all are the same because we compound this coupon for 2 periods, but 2 semi-annual periods. The interest rate applicable is half of the required rate of return, quoted in annual terms. The Present value of the third cash flow, therefore, R divided by 2 into the power 3. Last one, C plus A 1 plus R divided by 2 to the power 4. You add them together, you get the price of the quote. Same concept, only thing is what you have to do, adjust the interest rate according to the coupon frequency. So therefore, in the equation that I given in the presentation, in this you can rewrite this R instead according to the frequency. So we can write it as C divided by 1 plus R over F. What is F? You can write it as C over 1 plus R over F. What is this F? That is the frequency of coupon. How many coupons that you get per year? For the whole equation, you can change this part. Then remember, T goes here. That's not number of years. That is number of periods. If it is monthly payments, F would be 12. Then 1, 2, 3, 4 here means 1 month, 2 months, 3 months, likewise. If it is semi-annual, F would be 2, because 2 coupons per year. Then these time periods would be 1, 2, 3, 4 again, but 1 means 1 semi-annual period. 2 means 2 semi-annual periods. 3 means 3 semi-annual periods. So therefore, both the equations you can adjust accordingly, even the annuity equation. So we'll consider this example. We take this example and try to work out. Face value is 1 million, coupon rate 5%. The bond is maturing on December 15th, 2022. The settlement date is 15th December 2019. Face value 1 million. Coupon rate 5%. Maturity December 15th, 2022. Settlement December 15th, 2019. How many cash flows? And the frequency is annual. How many remaining cash flows? Or how many periods?
Three.
2022 December 15. Come back 1 year, 2021 December 15. Come back 1 more year, 2020 December 15th. This is 2019 December 15th. When the settlement date is on exactly a coupon date, you have received your coupon due on this date. So therefore, it is already priced into the book. You have only 3 remaining cash flow in the future. Correct. December 15th, 2020, December 15th, 2021, December 15th, 2020. The first part, timing. You should be able to identify this one, correct. Time. Then what is the coupons? What are the coupons? What is the coupon amount? Coupon amount is face value until you get familiar over time. It's better to write this face value coupon rate divided by frequency. Then substitute figures. Face value is 1 million. Coupon rate is 5%. Frequency is 1 because annual coupon. Then what is the coupon amount? $50,000. Correct. Every year on 15th December, you get 50,000 as coupons, but on the last year, December 15th, 2022, you get 50,000 plus this face value. So 50,000, 50,000, 50,000. Those are the coupons. But if I change it to cash flows, the last one is 50,000 plus 1 million. Now what do you have to do? Is any required rate given there? Now what do you need? Required rate of return R. It is not given. We'll assume we will assume R equals 5%. Then what is the price? As cash flow 50,000 divided by 1 plus 5 over 100. Or you can write it as 1 plus 0.05. Or straight away 1.05. The same thing. But be careful. Don't write it as 1 plus 5 because R in the equation R is a percentage figure. So you have to substitute it into the equation as a decimal. Either write 5 divided or the R divided by 100 or make it decimal. Then net. So remember that one. Then the second cash flow again 50,000 divided by. Now we have to discount this cash flow, but for 2 years. Third one, it is altogether 1,050,000. We have to discount this cash flow for 3 years. You do the calculation. If you do this, you would get it as 1 million. Do it by yourself and see whether you will get this answer. Same thing, we'll do recalculation assuming R is 5.1%. Even the coupon rate is 5%, you need 5.1% return. Then what would happen? Cash flows won't change. Remember that because cash flows will be decided based on the coupon rate, not your required rate of return. The cash flows will be dependent on coupon rate, not on the required rate of return. So therefore, no change in the cash flows. 50,000, 50,000. At the end, 1,050,000 remain same. Only change here is everywhere this would be 5.1. Then you will get something less than 1 million. You will get something less than 1 million. I'll give the answer in a short while. Just for the time being, if you can work out, you work out it and get the answer. It should be something less than 1 million. Now the third, if you move to third scenario, If your required rate of return is less than the coupon rate, 4.9, then again no change in cash flows, but the required rate of return 4.9, 4.9, 4.9. In this instance, you should get a figure greater than 1 million. We'll work out all these and find out the answers. I'll tell you what are the answers. You should get something greater than 1 million when the required rate of return is less than coupon. Cash flows would remain same. Only the discount rate varies, and the answer that you get vary depends on that. So one way that you can check whether your answer is correct is this. First, check the relationship between coupon rate and the required rate of return. If the coupon rate equals required rate of return, then the value should be equal to the face value. If the required rate of return is less than the coupon rate, then the price should be higher than the face value. If the required rate of return is higher than the coupon rate, then the price should be less than the face value. Let me summarize that. And this relationship, it's very important and you should remember that. Coupon, required return, price and face value. If coupon equals required return, if coupon rate equals the required rate of return, then price equals the face value. If the coupon equals the required rate of return, then price equals the face value. If coupon is greater than required rate of return, coupon is higher than required rate of return, then price is greater than the face value. If coupon is less than required rate of return, then price is less than face value. I'll repeat. If the coupon rate equals to required rate of return, then the price and face value are the same. If the coupon is higher than required rate of return, price is higher than the face value. That means to buy this bond, you pay more than the amount that you receive at the end. If the coupon rate is less than the required rate of return, then you pay less than the amount that you are going to receive at the end, the face value. So this is when this is the scenario, we call it the bond is trading at a premium. When the price is higher than the face value, we call the bond is trading at a premium. And this case, we call it the bond is trading at a discount. This is we call trading because the same value, par with the face value. Price is par with the face value. When the price equals to the face value, trading at par. When the price is greater than face value, trading at a premium. When the price is less than face value, trading at a discount. So the relationship between coupon, required rate of return, and price and the face value. Now we'll move into Excel. I'll show you. You can see the Excel sheet. I'll show you how to do the calculation. Face value 1 million. Coupon rate 8%. In this example, we had the annual frequency. We had 3 cash flows. What is the cash flow? It is the 5% of the face value. But in the last cash flow, you get face value as well. Then we'll calculate the present value of the cash flows. We need required return. Then we'll assume it 5%. Cash flow divided by 1 plus R to the power MP. So these are the present values of cash flows. The coupon payment that you receive in 1 year, 50,000. The present value at 5%. This is the amount. 50,000 that you are going to receive at the end of the second year. Present value of that at 5%, 45,351. 1,050,000. The present value is this. So the sum of these, so you can see it's same as the face value, because when the coupon rate is 5%, or the coupon rate and required return are same, face value and coupon value will be the same. Sorry, face value and the price would be the same. Now we'll change this 5% to 5.1. What do we expect? Price to be less than 1 million. So it's only 997,281. Here it's not 5%. Let me make it clear. Yes, it's 5.1. What would happen if you change this to 4.9? Price should be more than 1 million. So it's 1,02,728. Clear? So this is how do we calculate with annual coupon. But we can now let's assume semi-annual coupons. What are the changes? Instead of 3 cash flows, there will be 6 cash flows. Why? The settlement date was December 15th, 2019. The maturity date was December 15th, 2020. There are cash flows every 6 months. What is the next coupon date? This is June 15th, 2020. The next one, December 15th, 2020. The third one, June 15th, 2021. Then December 15th, 2021. Then again there's a cash flow, June 15th, 2022, and the last maturity date is the last coupon date. So there are 6 cash flows. Now, when we calculate the cash flows, now we have to be careful. How do you calculate the cash flow? Future value into coupon rate into 1 over frequency. That means divide by, what is the frequency here? Semi-annual coupon, that means 2 cash flows, 2 coupons for a year. You can see half of this coupon. and at the end you get the cash value as well. These are the cash flows. Then need to calculate the percent value. 25,000 divided by 1 plus now the required rate divide by 2 because it's a semi-annual periods and to the power number of terms. Now again, still, when the required rate of return is less than coupon rate, what do we expect? We expect price to be higher than face value. Now you can see the price is different. This is just because of the timing of the cash flows and the change in the amounts. If you make it 5%, still you get 1 million. If you make it 5.1 or whatever above, even say 5.05 above the coupon rate, then you should get a price less than the face value. Clear? Is there any questions? Any questions? If you don't have any questions, we move forward. So we discussed this example 1 and example 2. Now let's move into example 3. What is the difference? The scenario I want to discuss here is in the example 1 and example 2. You can see the settlement date is exactly on a coupon date. Then you have full periods, remaining full periods. That's why even in the we were able to use the powers 1, 2, 3 likewise. But in the third example, it is not the settlement date is not on a coupon date. It's 1st December 2014. Still the maturity date is 2020. I think better we'll make it 2019. Settlement date 1st December 2019. Otherwise, we'll get too many cash flows. And so make it December 1st 2019. Then let's see how to calculate the price. before that, before calculate that price, we need some understanding of some basic concepts. How many days between 6 or the June 15, 2019 to December 15, 2019? How many days? We need this because these are the coupon dates. The next coupon date is again June 15, 2020. If we assume semi-annual basis. If we assume semi-annual coupon payments, these are the coupon dates. But I want to know how many days are there in between. Again, you can use Excel if you want. Just type these 2 dates and subtract the big one. Subtract the small one from the big one. That means December 15th, 2019 minus June 15, 2019. You will get the answer.
183 days.
Sorry?
183 days.
183 days in this. Yes, correct. In the second period,
Same.
same.
Yes.
183. Correct? Is it correct? Okay, now if I ask from June 15, 2019 to June 15, 2020, how many years?
1 year.
1 year. How many days per year?
365.
365. So if this is a full 1 year period and we divide that full 1 year period into 2 6-month periods, we get 183 in each and altogether 366 days. Can someone explain why?
This might include the last date, like settlement date also.
No, it won't happen. It's not the reason, real reason.
That because of the leap year.
Yes, the 2020 is a leap year. There are 29 days in February. That's why you get this answer. Otherwise, you should get 360 or 183 days here. Then this may be 182 days. So, but in this specific example, we get 366 days. Okay, it's a different story. What I wanted to highlight, you should know how to calculate number of days between two given dates. Here, how many days between June 15, 2019, 12 15, 2019. Now, in this example, the settlement date is given as settlement date we consider it as 1st December. Not to confuse you, I use the same date format in Excel. December 1st, 2019. Month, date, year format. Now if I draw a timeline, now you have to price the bond. You know maturity date, 15 December 2022. Assume annual coupon to make it simple. Then the coupons will be clear. This is the settlement date. These are the coupon dates. Earlier, we didn't have this part. We settle on the exactly on a coupon date. Then we had full coupon periods. But now you get cash flow here. Coupon. Need to discount it back to this. Is there any full period, coupon period between 1st December and 15th December 2019? No. Clear? There's no full coupon period. Then how do you discount it? From here to here? Is it one coupon period? No. Is it two coupon periods? No. It is somewhere in between that. This is a full coupon period, 1 year. But from here to here, it's not 2 years, not 1 year. Somewhere in between them. How do we calculate the price? To do that, we need number of days in between the settlement date and the next coupon date. Number of days between the settlement date and the next coupon date. How many days? How many days in between 1st December 2019 and 15th December 2019?
14. 14
There
days.
are 14 days. This is correct. Don't get confused or say 15 days because the coupon date you cannot count. If you can remember, I explain you days are counting like overnight basis. If this is 1st December, this is 1st December time period, full day. This is 2nd December. To count, you kept this money for 1 day, you have to jump over this from 1st December to 2nd December, 1 day. 2nd December to 3rd December, 2 days. Likewise, on 15th December, during this is the end of 14th, this is the end of 15th. You keep this money until 14th. On 15th, you get this cash flow. So therefore, you don't keep that cash with the borrower for the 15th day. You get it. So therefore, interest is accrued only for 14 days. We need one more thing. What is the total number of days in this full coupon period? That means what is the previous coupon date to this settlement date? What is the previous coupon date? If it is annual coupon, previous coupon date is 15th December 2018. Clear? Now we are going to settle it on 1st December. The previous coupon that we received it on, assuming annual coupon, the settlement date is on 2019 December. The previous coupon was at December 15th, 2018. Now we need to know how many days in between this full year. How many days? There's no leap year, nothing. So that should be 365. Clear? For a 1 year period, there are 365 days. Then, as a fraction of years, what is the fraction of this time period? That fraction is 14 divided by 365. Clear? Because the whole coupon period was 1 year. In terms of days, 365 days. But the remaining period is only 14 days. So, in terms of years, it is only this much. 14 divided by 365. Now you have the timing. You can discount this cash flow. When you discount this cash flow, C divided by 1 plus R, what should go here? It's not a 1 year period, it's not a 2 year period, it's not, but it's that fraction. 14 over 365. This is the present value of the coupon that you are going to receive on December 15th. The present value as of December 1st, 2019. Then what about this one? Same coupon, 1 plus R. What's the power? It is not 1 year. If you discount it for 1 year period, you get the present value of the second cash flow, but as of December 15th, 2019. But you need the present value of this cash flow as of 1st December 2019. It is a 1 year plus 14 divided by 365. Third one also the same. 1 plus r to the power 2 years plus this fraction. The last one, three years plus the fraction. Again, you add them together, you get the price. Clear? When the settlement is taking place in between two coupon dates, you have to consider the fraction of the coupon period, the remaining fraction of the coupon period, and add it to the every time. Then only you get the correct percentage. Is it clear? Tell me, this price, is it the dirty price or the clean price? Maybe this instance, or it may be the previous instances that we calculate the price of the bond exactly on a coupon payment date, whatever it is. Whether that price is clean price or the dirty price.
Dirty price.
Dirty price. Why? Yes, correct. That is dirty price. Why? You discount all future cash flows. In this instance, this cash flow that includes this accrued interest as well. So this is dirty price. But when we price a bond on exactly on a coupon date, what would happen? There's no accrued interest. On that date, this dirty price and clean price equals. In the previous examples, what we calculate the price is exactly the clean price because there's no accrued interest. Clear? There's no accrued interest when we price the bond exactly on a coupon date. So therefore, in that instance, clean price equals dirty price because accrued interest equals to 0. But in all other instances, that means whenever we price a bond using this method, in between coupon dates, you get the dirty price. If you get the dirty price, how do you calculate the clean price? Okay, before we discuss that, if you know the dirty price, how to calculate the clean price, shall we do the same exercise with semi-annual coupon? With semi-annual coupon. So first December 2019, 15th December 2019, you get 15th June 2020, 15th December 2020. Now every 6 months you get coupons. The next coupon is 15th December 2019. When I say next, compared to the settlement date. December 2020, the next one. 15th June 2021, 15th December 2021, 15th June 2022, 15th December 2020. These are the timings of cash flows. This is the settlement date. The next coupon, and coupon plus maturity. There are 7 cash flows. There should be 7 cash flows. Now, this is the coupon date. What is the previous coupon date? What is this date? This is 15th June 2019. That is 15th June 2019. Now, again, there's a fraction of the whole coupon period. Therefore, instead of taking the number of days in the year, what do? We calculate this fraction as the number of days between settlement date and next coupon divided by the number of days in the coupon period. This is current coupon period. What is the current coupon period is 15th June to December 2019, because still we are in 1st December in this period. That is the current coupon period. This is the general way. Then if it is annual, number of days in the coupon period means number of days in the current year. If it is semi-annual, number of days in the current semi-annual period, calculating from the in between 2 settlement dates. If the calculate number of days in between 2 coupon dates. Okay, in this example, earlier we calculate there are 14 days between 1st December to 15th December. How many days between 1st June to 15th June to December 15th? That is 183 days. 15th June to December, there are 183 days. Correct? Then, when we discount this cash flow, this first one, we divide 1 plus R divided by 2 by this 2 here. The reason for this 2 here, it is because of semi-annual coupons. We get 2 coupons per year. Then we have to discount it only for this fraction, not for the whole coupon period. What is that fraction? It is 14 divided by 183. 14 is the number of days remaining there between the settlement date and the next coupon date. 183 is the number of days between the previous coupon date and the next coupon date. Then second cash flow, 1 plus R divided by 2, 14 divided by 183 plus 1, because it discount one period and another fraction. This one will be discounted 1 plus R divided by 2, 2 periods plus this fraction. We'll do that for each and every cash flow. Clear? The difference here is how do we calculate this fraction? It is the equation that I wrote earlier. Number of days between the settlement date and the next coupon date divided by the number of days in the current coupon period. When you discount like this and add them together, we get the price, we get the dirty price of the bond. We can do that calculation on the Excel as well. number of days in the coupon period is the next coupon date minus, sorry, this is wrong. This should be 2019. Next coupon date minus the previous coupon date. So 365 in the annual case. The remaining number of days in the current coupon period is the next coupon date minus the month date. Now these cash flows we have to discount 1 plus this fraction. We can do that change here. What's the reason that you cannot see the equation? Does anybody have any idea why we cannot see this equation in the equation bar? We'll do the adjustment here. The first coupon will be, there's another coupon indeed. This will be in this fraction. And this will be in one plus this. That's the problem. Okay. Now it's fine. Now you don't see this even the required rate of return is equal to coupon rate. You don't see the same amount. Is it clear? You don't see that. We'll discuss why is that. This is the way of calculation. However, I wanted to show you instead of 3 cash flows, now we have 4 cash flows because the settlement date is 1st December. So therefore, there are 4 cash flows on these days: December 15, 2019, December 15, 2020, December 15, 2021, and December 15, 2020. So those are the timings of cash flows. So in each period you get the coupon, and the final one you get the coupon and the face value. So we get this figure. We'll see why. Now we'll move into how to calculate the accrued interest. How do you calculate the accrued interest? I'll explain it. Then we'll come back and see what's happened. We'll consider the same example. Coupon date 15 December 2019. Settlement date 1st December 2019. The future. We don't want any future beyond this to calculate the accrued interest. So therefore, this is the coupon date. This is the settlement date. Next, coupon date was December 2019. Previous coupon date. If it is annual, what is the coupon date? If it's annual coupon, the next coupon date is 15 December 2019. Previous coupon date should be 15 December 2018. 5% coupon rate. In our example, it is a 5% coupon rate. Face value 1 million. What is the coupon that we expect here? Calculate it is 50,000. Coupon is 50,000 on this day. Now what we want to calculate is the accrued interest. Accrued interest for which period? from the previous coupon date to the settlement date. What is the accrued interest for this period? How do we calculate? For the whole coupon period, this is the interest income, the coupon. In this coupon period, there are 183 days. For the whole coupon period, there are 183 days. You can remember there were 14 days in between the settlement date and the next coupon date. Then in this period, from the previous coupon date to settlement date, how many days? 169. This period, 14 days. So this bond has accrued interest for 169 days out of 183 days. So this is 169. We use this fraction to prorate this 50,000 coupon. If you hold it for the whole coupon period, you have a claim of 50,000, but you hold it only for 169 days. Then out of this 50,000, how much you would get? 169 or 183 multiplied by this coupon amount. What is the figure that you get?
Excuse me, sir.
Yes.
Sir, you are calculating this to annual period, no? Just you are calculating it's a semi-annual.
Assuming
Here,
annual. I am doing this exercise assuming annual coupon. That's right.
annual.
That's why I used December 15, 2018 as the sorry.
Then
This
it
one. Yes,
365 days.
yes, I got it. If it is annual, this 14 days remains as it is. Then for this period, it should be 365 whole period. Then 365 minus 14, 351. Correct? That should be the fraction. There are 351 days from December 15, 2018 to December 1st, 2019. Sorry about it. Yes. We are calculating this based on annual coupon. So therefore, from the last coupon date to the settlement date, there are 351 days. From this coupon date, settlement date to the next coupon date, there's only 14 days. So you accrued interest for a 351 days out of 365. And the total amount is 50,000. Then what is the accrued amount? $48,000. Correct? Is it correct now? So this is the accrued interest. Accrued interest for a 351 days. If it is semi-annual, what I did earlier by mistake, calculate the number of days from the last coupon date to settlement date. Sorry, there's another mistake. No, this is correct because for the annual period, coupon is 50,000. For the annual period, coupon is 50,000. Fraction is 351 over 365. From the last coupon date to settlement date, there are 365 days, 351 days, and for the whole period, there are 365. If it is semi-annual basis, this would be June 15th, June 2019. Then there will be 169 days and 14 days. Then the calculation is different because what is the coupon payment for a semi-annual period? It is only
25,000.
25,000.
25,000.
And the fraction would be 14 divided by 169. This is the accrued interest if it is a semi-annual period. Clear? Is it clear? So very simple calculation. What we have to identify, what is the proper coupon period, what is the length of that coupon period in terms of days, number of days, and how many days lapse in that coupon period up to the settlement date, not the trade date, up to the settlement date. Clear? Then you use the you prorate the coupon income according to the number of days that you hold. Again, there's a mistake. This should be 14. It should be the whole period is 183 and the bond was held for 169 days. From the last coupon to settlement date, in this semi-annual period, 169 days, the bondholder holds it, and full coupon period is 183 days. You might get 24,000 something. Now, if you go back to the, if you can remember the accrued interest annual period, it came as 48,000 something. Remember? Is it correct? Note it down, that figure. 50,000 into 351 divided by 365, you will get 48,000 something. Is it correct?
Yes, sir.
Yes, you can do it on Excel. Can you see the Excel sheet?
Can't see.
I think now you can see. Yes?
Yes.
Yes. Okay. For the accrued interest, but we need these things. Okay, we have all these. Accrued interest is, to make it clear, we'll calculate the coupon. It is the face value into coupon rate because it's annual, 50,000. And the remaining number of days, 14. For the whole coupon period, it's the $365. So therefore, accrued interest is 50,000 into, what I can do is 365 minus 14. That means whatever the past period, divide by 360, because 365 minus 14 will give you 351. 48,000 and 82. So you can see this is the accrued interest amount. Now you can see the price what we get is very close to 1 million plus this accrued interest. Why it is not exactly same? That means this includes the accrued interest. I explained earlier, when you use this calculation, you get the dirty price. So you get it with the accrued interest. If you deduct this accrued interest component, you get close to 1 million. There's a small difference. Why is that? We calculate this accrued interest amount as of 1st December. This 48,082 cents. But what has happened here? It has been discounted, that 50,000 to the 1st of December. That's why there's a small difference. Though the new buyer pays it on the settlement date, the buyer will receive it on a future date as the coupon payment. There's a time value in that period, but we in the settlement we ignore it. We don't worry about the time value of that accrued interest the buyer pays to the seller. Is it clear? What I am explaining? If the previous bondholder holds that bond to get the cash flow, he has to hold it until next coupon date. That means in this example, until 15th December 2019. Instead, what he did, he sold it 1st December 2019. Then he gets a cash flow accrued up to the 1st December. But what he should have received in December 15th, he get it in front, but there's no discount for that. But when we calculate the price, it is discounted. That's why there's a difference, and we ignore that. In the real life, we don't consider the time value of that accrued interest. We paid it as it is. So this is about accrued interest and calculation or the valuation. If you have any questions.
Okay, clear.
So shall we take a break then?
Yes, yes. Wait,
Let me move into this one. So what we discussed so far, just these 3 slides. How to do the valuation and maybe the accrued in. Yes, and the accrued interest. So now you should be clear about the relationship between price, coupon rate, and the face value and the required rate of return. The relationship between coupon and the required rate of return, how does it affect the price of the bond? And how to calculate the price, even if the settlement date is in between coupon dates, and how to calculate the accrued interest. Now you know how to calculate the accrued interest, and we learned the equation to calculate the clean price, that is calculate the dirty price. Dirty price is the clean price plus the accrued interest. You know that if we use this equation, we get the dirty price. Then you know how to calculate the clean price. So now you should be able to do all those things. After the break, we'll discuss this yield to maturity and yield curves. Is it okay? If you have any questions, okay, we'll take the break. During the break also you can think about it. After the break, if you have any questions, please free to ask. So we'll take a 10 minutes break. Now it's 10:40. We'll start at 10:50. So I'll show you then this Excel function to calculate the one price. So you can see the Excel sheet. Is it correct? Can you see the Excel sheet? So the equation is price. Then the first argument for that equation is the settlement date. So we have put settlement date. Then the next is the maturity date. So I have not put the maturity date. I select this one. Then the rate. Rate is the coupon rate. Next one is the yield, that is the required rate of return. Redemption, that is the face value. Frequency, whether it's annual, semi-annual or quarterly. We'll put semi-annual. And the basis. Basis is day count basis. In our previous examples, what we use is the actual. That's why we calculate actually how many days are in between coupon period, coupon dates, and a settlement date and a coupon date. So therefore we'll use this actual. How about I select C23. Next coupon date as the settlement date. The date was 15th December 2022, and I'll change it here instead of C23. C9 rate 5%, C20 yield, frequency, redemption 1, annual, and the day count basis. This is the, now you can see the this is the equation. Just remember what are the parameters. First one is the settlement date. Then the second one is the maturity date. Third one is the coupon rate. Fourth one is the required rate of return, which is we call yield. We'll discuss this in a minute. Then the face value, redemption value, frequency, on which frequency you pay, you get the coupon, and the day count basis, whether it's actual or actual 360 or 360. Likewise, it gives you 186. I need to check why this is this low. Something wrong there. I'll check and let you know what is wrong. However, this is the equation. You can use this. You can say when we try to type price, it says returns the price per $100 face value of a security that pays periodic interest. That may be one reason. I'll check it and let you know. However, the equation is this price, and remember the arguments. We'll move into the presentation. So we are going to learn again few new terms. Yield to maturity, yield curve, and changes in the yield curve. What is yield to maturity? It is another name given to the required rate of return that we used. Simply we call it yield, but the real term is yield to maturity. What does it mean? If you hold this bond, any bond, buying at the current price, what is the return, annualized return that you get if you hold it until maturity? Not only that, there are interim cash flows, the coupon payments. If you can reinvest those cash flows again until maturity at the same rate. So for example, in the previous one of our previous examples, we used required rate of return as 5.1. So all future cash flows, coupon payments, if we can reinvest at the same 5.1% rate until the maturity of the bond, then the annualized return that we get is, we call it yield to maturity. It should be 5.1 itself. That is why we call it yield to maturity. The rate of return that we earn if we hold this bond until maturity, and if we can reinvest all the coupon payments at the same rate until the bond matures, or for the remaining maturity of the bond. That is why we call it yield to maturity. Now I just use a word remaining maturity. What does it mean? Say in our example, this bond, I haven't given you any issue date or the first settlement date. So sometimes we don't want that. What we are worried about, what is the maturity date? So what is today and what is the remaining maturity? So if you take this bond, it's maturing December 15th, 2022. Today is 19th July 2020. What is the remaining maturity? How many more years or how many more days remaining there until the maturity of this bond? So for this one, it's about just 2.5 years, less than 2.5 years, because now we have passed June 15th of this year as well. So less than 2.5 years. So remaining maturity of this bond is 2.5 years. But this might have issued maybe in 2012, originally as a 10-year bond. Originally, it's a 10-year bond, but now it's only 2.5 years. So therefore, there's a difference between original maturity and the remaining maturity. In this bond, the remaining maturity is only 2 years and 5 months, we can say. So therefore, when we talk about this yield to maturity, we assume whatever the coupon flows, say there's a, now in this bond there should be a coupon in this December. We should be able to invest that coupon payment for a 2-year period at the same rate. With that 3 assumptions only, we can realize this yield. Otherwise, this yield may change time to time. But at the time of buying the bond or making the investment, this is one of the figures that we can consider to make the investment decision, whether to buy this bond or not. If a 2-year bond now today gives us 6% yield to maturity, we can think about it whether that 6% is enough for me for a 2-year period. If it is not, if you think 6% is not enough, you should not buy that security. If you think 6% is more than enough, then you should buy that security. So yield to maturity is another term for the required rate of return, and we think that we can realize that rate of return if we hold that bond until maturity, and we can reinvest all those coupons at the same rate. So therefore, there's a risk, that is the reinvestment risk. If you cannot reinvest whatever the future coupon payments at least at the rate or the yield to maturity as at today, then you won't be able to realize that yield. It may be less than that. But if you can reinvest it at a higher rate, you may be able to realize a higher rate than the yield prevailed as at today. So that's why in a bond, there's a risk. We call that reinvestment risk. We should, to realize the yield as of today, in future, you should be able to make reinvestments of cash flows at the same rate. If interest rate moves down, you won't be able to reinvest cash flows at the same rate, and you may not be able to realize the return that you expect at the time of buying the bond. This is the equation to calculate calculation of accrued interest. So basically, this part is the calculation of coupon. Face value into coupon rate divided by coupon frequency. This is the coupon. Then this part is the adjustment. That means prorate the coupon for the whole coupon period for the number of days. That's why it says days from last coupon date to settlement date. That is the holding period from the last coupon date divided by the number of days in current coupon period. So though generally we use this equation, these two can change depending on the day count convention given in the bond. If we use actual, that means for any period we calculate the actual number of days. So therefore, days from last coupon date to settlement date, we calculate actual number of days. And for the whole coupon period, we calculate actual number of days. But if it is like actual 360, then for a 1 year, we assume there's only 360 days. For annual coupon bond, this may be then 360 days, not 365 or 364 or 366. But this part may be the actual number of days. If we assume 30 actual or 3360 days, if we assume 3360 days, again for a month we assume there are 13 days, and for a year there are 360 days. Therefore, this denominator would be 360 for annual coupon bond, 180 for a semi-annual coupon bond. And this part depends on the number of months that you hold. We think for a month there's only 30 days. But if it is again not complete months, then again we calculate the number of days that you hold. So basically we use this equation to calculate the accrued interest. And now this is the relationship between price and yield. Yield, again, I would say the required rate of return. The relationship is like this. In the x-axis, you can see the yield to maturity or the required rate of return, and the price on the y-axis. If you go back to this equation, you can see this is not a linear relationship. That means, okay, what would happen if R increases? If R increases, your required rate of return increases, the present value of all these cash flows would be low or go down. Then this price goes down. We have an inverse relationship. When the rate of return increases, price goes down. So in terms of yield, when the yield increases, price goes down. But it's not one-to-one or a linear relationship because of these powers. You don't discount each and every cash flow by the same amount. You use different discounting rates. So therefore, this is the relationship that you can see for a particular bond. The relationship between yield to maturity and price. When yield decreases, price increases, but the level of increase is very high when yield becomes very low. But when yields becomes very high, rate of decrease in prices will be low. It's almost flat. Even though you increase yield here, price won't go down drastically. So this is a very important relationship. Not only this direction, the inverse relationship, when the yield to maturity increases, price decreases, or when yield to maturity decreases, price increases. Not only that, remember that the shape, it's not a linear. It's an inverse relationship, but it's not a linear. It's a curve. Remember that shape. This is very important. Later, maybe next week, we are going to discuss two concepts called duration and convexity. That's some risk measurements used in fixed income securities, because those measures are used to measure the sensitivity of yield change to the sensitivity of price change to the changes in yield change. You know, if the yield changes, price changes. What is that sensitivity? That is, we measured through duration. We'll discuss duration and convexity next week. But this relationship between yield to maturity and price is very important. Another thing, we are going to learn another concept called yield curve. Remember, this is not the yield curve. This is the price yield relationship. This is not the yield curve. Remember that. And there's another one measure that sometimes we use to get some idea about what is the return that we get. That is called current yield. This is a very simple way of calculating the yield that you may earn. That is just the coupon divided by the price. What is the coupon that you are going to receive during a coupon period, and what is the price that you are going to pay? So that is for your investments, what is the return during a coupon period? Usually you calculate the return for annual period. Therefore, this coupon would be annual coupon amount divided by the price. You know how to calculate the coupon. That is the coupon rate into face value. So in the previous bond, in this example, Excel example, when the yield is 4.49, we pay something close to 1,002,000. If you want to calculate the current yield, what you have to do, you get a 50,000 coupon for a year and divide it by the price that you are going to pay. Again, it would be better divided by the clean price, because the calculated price include the accrued interest. So this is a very simple calculation. If the current yield is high, you will tend to buy that bond than similar maturity bond with a low current yield. Then
that part will you so that part will you able to explain it again, like the purchase testing, like current yield, that particular part, what
current
you
yield.
last.
Current yield.
Yes. How?
Say you.
Yeah. What are? Yes.
Yes. Say you have two bonds. Two bonds maturing in 5 years. Maybe coupon of one bond may be 10%. Coupon of another bond may be 8%. And the yield may be slightly different. One thing you can do, compare just the yield to maturity. You just compare yield to maturity. Whichever bond gives you higher yield to maturity, you may buy that. That's one way of selecting a bond to buy. Yield to maturity is high means there's a chance that you get a high return than the other bond. So you go for that. Or if you want to think about just the current yield, what you would get during the next 1 year, then yield to maturity may not be a good indicator, because to realize that yield to maturity, you have to hold that bond until maturity. You have to reinvest all the cash flows at the same rate. Those things are there. But if you are worried about only the next 1 year period, then what you have to do is just think about what is your investment today, what do you get in a 1 year's time. If you buy a bond today, in 1 year's time, what do you get? Only the coupon income. So what is the ratio between that? That is the current yield. Then if you want to compare two bonds, again, you calculate the current yield of two different bonds. Consider to buy the bond which gives you a high current yield, because yield is what you get. What is your return? That reflects what is your return. You want high return, so you buy the one with high yield. It may be high yield to maturity, or it may be high current yield. Is it clear?
Yes, sir. Yes.
Okay. Any other questions? So now and onwards, I don't use the word required rate of return. I just use the word yield. That means whatever the trade that we are using to discount the future cash flows. That is yield to maturity. We realize that yield only if all the bond until maturity, and if we reinvest all the coupons at the same rate until the maturity of the bond. Now we'll talk about the yield curve. Yield curve is the term structure of interest rates. Yes, I think you can see this graph clearly. In this, there are two axes. X-axis, it shows the time. 1 month, 3 months, 6 months, 1 year, 2 year, 3 year, 4 year, 10 year, and 15 years. On the y-axis, it shows the yield. Remember, x-axis price, tenor, x-axis tenor, y-axis yield. In the previous graph, where we discussed about price yield relationship, x-axis was the yield and y-axis was the price. In the yield curve, no price is here, but different maturities and corresponding yields. So it shows us the term structure. That means for different tenors, what is the required rate of return. So this was for the government bonds. If you want to buy government bonds, what would be the term structure? It's not the current one. I think it's 2011 one, pretty old. At that time, for the 3 months, interest rate or the yield was 7%, just above 7.012, something like that. 6 months, just about 3 months, still less than 7.25, maybe 7.1, something like this. But you can see with the time increases, the required rate of return or the yield increases. If you can remember, go back to the beginning, we discussed what are the components of interest rates. We consider the risk-free rate, nominal interest rate. If we discuss the nominal interest rate, we discuss about the nominal risk-free rate, and at the credit risk premium, liquidity premium, maturity premium, things like that. So that's why here basically we assume the liquidity premium is added or the maturity premium is added. That's why with the time interest rate increases. If you want to lend to the government for a 10-year, you need at least 9% yield. That's how you read this. And one thing, when we see this yield curve or the yield increases with maturity, we call it a normal yield curve, increase in yields with the increase in yield, positive yield curve. What does it reflect, or how do we read it? We expect in the future short-term interest to go up. That's why we see future the interest rates for long terms are higher than the short term. This sort of yield curve we call a normal yield curve or a positive yield curve. The slope of the yield curve is positive. When the tenor increases, yield increases. Basic concept here. First, you have to understand what is the yield curve. Yield curve shows the relationship between yield and the tenor. Remember that. Yield curve that represents the relationship between yield and tenor. For different tenors, what are the yields? And basically for a country, we use the government securities yield curve, but there can be different yield curves. It may be yield curve of government bonds. It may be AA rated corporate bonds. Likewise, because yield is not same for everybody. As I mentioned earlier, you don't lend to a corporate at the same rate that you lend to the government. There will be a premium, and the premium may change according to the time frame as well. So therefore, when we generally say yield curve, we refer to the government bond yield curve of a particular country. But in any case, if you want, you can refer a corporate bond yield curve or supranational yield curve or the AA curve, something like this. That for different categories, different yield curves that can exist. But most of the time we use the government yield curve for analysis. So there are different shapes of yield curve: normal, flat, inverted, and humped. What is a normal yield curve? As I showed you earlier, with the positive slope, that means when the yield is increasing with the tenor, we call it a positive yield curve. Yield curve, this is time, this is yield. If the yield curve is like this, it's a normal yield curve. With the time, yield increases, but gradually rate may decrease. Then the next one is the flat. Flat yield curve. What does it mean? There's no change of the yield with the time. It's just a line, horizontal line. That's why we call it flat. This is a flat yield curve. In real life, you won't see exactly like this or exactly like this flat yield curve. So no, normal yield curve. What I showed you, Sri Lankan government curve in 2011. It is not exactly like this, but just like this. But still we can say it's a positive yield curve. Then the third one is, okay, in this I explained when you see a positive yield curve or a normal yield curve, we expect short-term interest to go up in the future. What do you expect when you see this sort of yield curve, a flat yield curve? We expect even in the future the current interest rate to be remain same. There's no change in the, we don't expect any change in the interest rates in the future. We think the current yield will remain in the future. Then the third one is the negative or inverted yield curve. What does it mean? In the inverted yield curve, short-term interest rates are high, long-term interest rates are low. This is an inverted yield curve. Short-term yields are high, long-term yields are low. When do you expect this sort of yield curve? Investors think the economic conditions are not good, therefore, in the future, short-term interest rates will go down. In the future, short-term interest rates will go down. That's why you see inverted yield curves. Indeed, you can observe not exactly like this, but you can see some yield curves. 10-year yields is lower than the 1-year yields. That can happen, and you can see that. Even now, in some countries, you can see this sort of yield curves. And the fourth one is humped yield curve. That means it may be something like this. There are humps in the yield curve. No exact. Those things we call humped yield curve. So then the different tenors, they expect different movements. we can consider this as a normal yield curve. This is a sort of inverted yield curve. At least up to 2 year, 3 year, 5 year. Yield curve is inverted. Yields are lower than the short-term 3 months, 1 year rates. Then again, next part, it gradually increases. Or you can say this is a humped yield curve as well.
So in countries like Sri Lanka, what sort of a yield curve we can witness?
That depends on the. That depends time to time. Still, we see positive. In these days, also we see the positive yield curve. Though the interest rates going down, still we see the positive yield curve. But there were periods. There were periods that we observed the inverted yield curves.
Positive yield curve in the sense normal yield curve.
Normal yield curve. Yes. With the time increases, yield increases.
Okay. And where can we get the yield curve for Sri Lankan development bonds and bills? Yield curve will published by central bank or something like that in practice. Like if you want to get yield.
One place is Bloomberg or Reuters.
Okay.
You can get it. So all these screenshots are from Bloomberg. The other thing is, okay, one more thing. The yield curve, now all these things are graphical representation. So it's need not to be a graphical representation, it can be a table. So for different tenors, say 1 year this is the yield, 2 year this is the yield. You can see that table. That's the yield curve. So on newspapers also you can see for different maturities, government bonds, different maturities, you can see the yield. So you can use it as a yield curve. And one thing, say now in this screen, there are points 5 year, 10 year. That may be the mostly liquid bonds available in a particular country. There are more liquid bonds in 10-year sector and 5-year sector. So from the market, you may be able to find the yields, proper yields for these securities. But in between that, there may not be observable figures continuously for each and every maturity. But when you represent it graphically, most of the time, what you do a interpolation and estimate the curve in between some points. You pick the yields from the market for key points and estimate the others using some interpolation method or some other estimation method. That's how you develop the yield curve if you want this sort of graphical representation. Or say you want to find what would be the yield for 8 years. In this 7-year yield is given, 10-year is given. If you want to get this 8 years, probably this graph may have used a interpolation. That's why you get 7-year, 10-year sector is like a straight line. If you use linear interpolation, you get the proportionate increase in the yield up to 1 year. So that's the way. You don't observe yield in the market for each and every maturity, but you may observe at different points. Others you estimate. There are different ways to estimate the yield curve. Simple one is linear interpolation, but there are so many other ways. In Sri Lankan markets, easily where you can get is daily public debt department publish prices of bonds. You can use that, or in some newspapers daily they publish some maturities and government bond maturities and corresponding yields. You can use those to generate your own yield curve. Or if you go to the Bloomberg, depending on the data availability that they have developed the yield curve. But there may be slight differences among those, depending on the price sources and availability of prices. Is it clear?
Yes.
Okay, we were discussing about different shapes. Yes, any question?
The yield curve published by public debt management is accessible for everyone, no? That is only accessible for certain people, like.
No, that basically what public debt publishers is they collect some information from primary dealers depending on their transaction.
Okay.
Edit in the market. So basically, anybody can use those. It's because it's only for the government sector. That's the government
Okay.
yield. That's the government yield curve.
Government.
If you want to develop a yield curve for a corporate, then you may have to add some premiums to that at different levels. You won't add 100 basis points throughout across the board or for all maturities, but for less mature, lower maturities, you may add 25 basis points. For a 10-year, 5-year, you may add 2-3%. That means 200 or 300 basis points. Then you can develop a yield curve for other sectors. But the public debt publishes the yield curve for the government yield curve. We call it government for the sovereign yield curve. Even here you can see this box yield graph, US Treasury actives. That means US government securities, the actively trading US government securities. What is the yield curve for US government securities? This is also US government. This is for the Australian government. You can see AUD Australia sovereign. This is the Australian. So now you can see it's a hump. Initially, within 2 to 3 year sector, they expect interest rates to go down and then to increase the yield. So you can see, you won't see exactly what I drawn on the black or the board, but some sort of combination of those in the real life. And then the other thing is steepness of the yield curve. That means if you consider 2-year to, this is 15-year, what is the slope? Though it's upward, if we move into the two different yield curves, YC1, YC2. Both are upward sloping. With the time, yield increases, but at different rates. For the short end, almost same interest rates, but long end, there's a difference. The slope of this yield curve is much higher than this. That means this slope. We measure this slope in yield curve very in the simple manner. Yield in the long end minus yield in the short end. What is the difference between these two? You can see in the yield curve that difference is high compared to this. So this is a steepness is a relative concept compared to this yield curve. This is the yield curve 2 is a steep yield curve. There's a high slope. What does it mean? With the time, yield increases at a higher rate. With the time, yield increases at a higher rate. In a positive yield curve, the slope or the steepness would be positive. Long end yield is higher than the short end. So therefore, this difference is positive. Generally, we measure it against 2-year, 10-year and 2-year, the difference between 10-year and the 2-year yield, generally. That gives you some idea about the future interest rates. The steep slope is positive when it is a normal yield curve. When it's inverted yield curve, 10-year yield may be lower than 2-year yield, then it would be negative. And the steep and flat. So when we say yield curve 2 is steeper than yield curve 1, on the other hand, we can say yield curve 1 is flatter than yield curve 2. It is a relative thing. So even if the same yield curve, that means say Sri Lankan government yield curve, in 2 different times, you may see 2 different steepness. In sometimes you may see this very steep yield curve. Sometimes you might see this some flat yield curve. When you don't expect interest rate to rise at a higher rate in the future, the curve would become flat, close to flat, the real flat. This is flat. So if you can see a yield curve something like that, it's relatively flat one. But instead, if you see something like this, it's a very steep yield curve. So steepness and flatness, it's a relative concept. However, what does it measure is the slope of the yield curve. With the time, how fast the interest rate or the yield changes. So we measured it as the difference between long-term yield and the short-term, generally 10-year minus 2-year. But if you want, you can use some other tenors. Then, as I mentioned, the yield curve won't remain same. It may change time to time. So there are 2 basic types of changes of the yield curve. One we call a parallel shift. The second one we called a non-parallel shift. This is the current yield curve. If this yield changes at every point in time, that means say this is 3 months and this is 2-year, this is 5-year, this is 10-year. This is 15-year. Assume 4%, 5%, 5.5%, 6%, 6.25%. That's the yield curve. If the yield curve moves, say upward, if interest rate goes up in every tenor, we call upward shift of the yield curve. Going up, every tenor yield goes up. If that by the same amount, assume say 0.25, in every point yield increases by the same amount, then this 4 would become 4.25. 2-year 5 would become 5.25, 5.75, 6.25 and 6.5. So when you draw this, everywhere this difference should be the same. That sort of shift we call a parallel shift. Across the board, yield change is the same. For each and every tenor, yield changes by the same amount. It can be an upward shift or it can be a downward shift. From here to here, we call it an upward shift. From red line to the black line, going down, all interest rates, we call it a downward shift. But everywhere is the same level of change. That is called parallel shift. The non-parallel shift is something like this. Current yield curve is like this. Assume yields going down. What has happened? From 1 to 2, interest rate has gone down, but at different tenors by different amounts. In the short end, the interest rate has gone down only by a very small amount, but in the long run, it may be 2-3%. Whether decrease or increase of the yield by different amounts in different tenors, we call it a non-parallel shift. And with an unparalleled shift, what you can expect with regard to steepness and flatness, what would happen? This is a steeper curve, this is a flatter curve. Because the difference between short end and long end is small compared to this. So the curve has flattened from 1 to 2. If it is 2 to 1, curve has steepened. That can happen in a non-parallel shift. But in a parallel shift, the steepness would remain same, but the curve shift upward or downward by the same amount. In a non-parallel shift, curve shift upward or downward in different amounts. In the non-parallel shift, again, two things can happen. One is twist in the slope or the hardness of curvature of the yield curve. So yield curve like this may be shifted to a yield curve like this. Short end increases, long end decrease the twist. And the that may become much lean. Yield increases but in different amounts. Therefore, this curvature has reduced. Or it may be the curvature may increase from this curve to may become like this. Then the curvature has gone up. Curvature has increased, not the level shift. So these changes can happen, the results can happen. So in this is the first, this is the second. This is the first yield curve. Then it shifted to this. Yield in the short end increases, short end or the long end decreases. That twist the yield curve. Or it can be like this, as I explained. If the yield curve is like this, the next time it may be like this. The hardness or the curvature has changed. In an unparalleled shift, any of these can happen. So, flattening, steepening, as I mentioned earlier, that can happen even when the interest rate increase or decrease. But what should happen to flatten the yield curve? The slope should decrease. That means the difference between the short end yield and the long end yield should decrease. Then we call the yield curve as flattened. To steep the yield curve, the difference between the long end yields and the short end yield should increase. Then we say it's steep. Then there's another thing called positive butterfly and negative butterfly. I'll show you. Again, that can happen when the interest rate increase or decrease. This is the original yield curve. What would happen? The short end and the long end interest rate in a scenario yield increasing, short end interest rate increase by a large amount, and the long end also increase by a large amount, but not the middle. So it may be something like that, or it may be Yes, something like that. The positive butterfly means the change is like this. Time and change in yield. Short end and the long end, change in the yield is higher than the middle. That's why now it's like a butterfly. That's why we call it a positive butterfly. The same thing can happen even if yield decreases. Long end, short end and the long end yield decreases by a higher value than the middle of the belly of the curve. Then we call it a positive butterfly. The opposite is the negative butterfly. What does it mean? Yield curve is like this. The yield in the middle area increases than an amount in the short end and the long end. Then the curve would become something like this. Middle area increases, but the long end and the short end by very small amount compared to the change in the middle. This is a negative butterfly because if we calculate the change, it will give you a something like this. Change in the yield, this is change.
We can't see.
Sorry?
We can't see them. We can't see.
Back pen you can see, no? The change would be like this. This is the change in the yield. This is time. In the middle tenors, you can see a large change in the yield compared to the changes in the two ends, short end and the long end. That's why we call it a negative butterfly. Again, that can happen when the interest rate increases or the interest rate decreases. If it is increased, short end and long end increase by a small amount, but the middle yield increases by a large amount. If it is decreased, short end and the long end yield decrease by a small amount than the decrease in the yield in the middle tenors. Then it will be a negative butterfly. So the positive butterfly and negative butterfly. But two most common types of shifts are the downward shift and the upward shift. Maybe not non-parallel, but this is the very common, even though it's not parallel. Generally, curve shifts upward or downward, maybe with some steepening and flattening. That's the most common type of shift, but depending on the conditions, economic conditions, that may change. When we see recessions, the curve becomes more inverted. Then you might see not only upward and downward, but the hump or changes as well. And the other thing is, yields in the short-term sector tend to be more volatile than the yields in the long-term sector. Therefore, in most of the countries, the yield long-term end fixed somewhere, say 10 years, 15 years. So if there's any 30-year maturity, those yield won't change by large amount as a percentage compared to the existing, say 10% becomes 10.5. The volatility is different from 1% becomes 1.5. 1% becomes 1.5% means 50% change. 10% becomes 10.5 is not that so, 0.05%. So likewise, in that terms, the volatility is higher in the short end than the long gain. Long gain usually anchored around some figure. Even though yield increases, decreases, it will hang around there most of the time. But the impact on the bond prices is different. Even for a very small change in the long gain, price of a long gain bond may change drastically. So we'll discuss those with the concept of duration, but meantime you can do some exercise. So take a hypothetical bond and use the exact coupon dates. No need to worry about accrued interest or things. Say start with the 5% 2-year bond and the yield to maturity say 5.1. Do the pricing. Then change the yield 5.1 to 5.2. See what is the price change. Change that yield 5.1 to 4.9. See what is the price change. Do the same thing for a 5-year coupon 10-year bond. See what is the price change. You can get some idea about the yield sensitivity of prices to a change in yield. However, we'll discuss those next week when we discuss duration. Then fixed income securities, there are risks associated with. As I explained earlier, reinvestment risk is one of those risks. Whether you will be able to reinvest whatever the coupon income at the same rate until maturity. If not, you won't be able to realize the yield to maturity that you expect at the time of you buy the bond or invest in the bond. The other thing is, when the interest rate changes, the price of the bond changes. If we go back to this Excel, so you can see when the yield is 4.9, price is this. If the yield is 5%, price is 1 million. If the yield is 5.05, it's only 998. If the yield is 5.2, it's 994,000. So when yield increases, price decreases. You observe that, no? 5.2, 5.05, price increases. 5 into sorry. When the yield becomes 5, value becomes 1 million. When it becomes 4.8, it goes above 1 million. So that's the relationship that we discussed earlier. So when the yield changes, value of the bond, your investment changes because of this price changes. That's a risk. You buy a bond today, tomorrow interest rate increases, the value of your investment goes down. On the other hand, what does it reflect? You could have waited one day and invest your money at a higher rate than what you got yesterday. So that risk is there, which is called the interest rate risk or the market risk. So when the interest rate changes, price changes, and when the maturity of the bond is long, price sensitivity is also high. I can show you that one as well. Can you see the Excel sheet? So do I have to do this?
Counter.
Now you can see.
You can
Yes.
see.
Okay, now we'll consider, we'll convert this without taking semi-annual. Assume this is a 1, 2, 3, 4, 5, 6-year bond. Okay. Now instead of I'll change it to a annual coupon bond. %, 5%, sorry, 1 million, 5% coupon, required rate 5.1. We need to divide by 2 now. Okay, fine. Now you can see what is the difference between these two bonds. And both are annual coupon. Coupon rate is 5%. Required rate is 5%. Now both are at par. If I increase this to 5.1, this is the change in price from 1 million to this price decreased by 2,000. If I do the same here, now the price decreased by 5,000. You can see same change in the yield. 0.1% change gives a higher price change in the long game. That means 6-year maturity bond. You can see there are 6 terms. That means 6-year maturity, because I changed this to annual coupon. You can see the same change in yield. Longer tenor security prices moves by a higher amount. That's what it says in this. You can do this exercise by yourself as well. Take some hypothetical bonds and do the calculation. The longer maturity of the bond, the more the sensitivity is to interest rate. For the same change in the interest rate, longer maturity bonds prices would change by a large amount. It may be increase or decrease depending on the interest rate movements, but by a large amount. Then the duration is the measure of that sensitivity. What is the change in price for a given change in yield? So there's a specific duration called modified duration. It gives what is the percentage price change in price for a 1% change in yield. If you change the yield by 1%, what would be the percentage change in the price? That is we call modified duration. So we'll discuss how to calculate duration, how to interpret duration and things next week. That measures the interest rate risk. Duration is a measure of sensitivity of bond prices to change in the discount rate or the yield. That means that is the interest rate risk. I'll discuss how to calculate duration in the next week. There's a separate handout presentation on that. We'll discuss that. So therefore, just for the time being, remember that duration is a measure of interest rate risk. And not only that, the credit risk is there. Why? There's a borrower. The borrower, who is the party, issue a bond or a fixed income security. That party may or may not be able to pay coupon income, coupon payment, or the maturity payment on time. It may go bankrupt. As investor, you may not get anything, any cent. So therefore, that credit risk is there with the issuer. Once you buy the bond, you take the risk of the issuer, the credit risk of the issuer. So therefore, you face that credit risk. But in trading, you face the counterparty risk, because as we mentioned earlier, when the bond is issued in the primary auction, then the bonds are held by investors. Then the trading would take place among investors. Nothing to do with the issuer unless paying coupon payments and maturity proceeds. If you enter into, say, party A enters into agreement to buy a bond from party B, there's a counterparty risk. You may pay whatever the rupee amount due to party B. Party B may not deliver the bond or the ownership of that bond to you. That can happen. That is the counterparty risk in a fixed income security transaction when you trade the bond. But in many countries, including Sri Lanka, that risk has minimized, introducing a method called delivery versus payment. Because all these bonds are settled through a system. In that system, the transaction won't settle unless that system sees cash from the buyer side and the bonds from the seller's side. If the system can see both cash amount and the equivalent amount of bonds in the system, both parties have the possession of these, then only the system exchange the ownership. You deliver, then you get the payment, or you pay, then you get the delivery. That's why it's called DVP. The other one is liquidity risk. When you buy a bond, that means you invested for a longer period. You lose some of your liquidity because you may not be able to use that cash. But if that bond that you bought is very liquid in the market, that means you can easily sell it, then you have the liquidity still. That's why government securities are considered as liquid in Sri Lankan markets. Compared to other investments, you can sell a government security relatively easily compared to other corporate debentures or things like that. So the liquidity twofolds. One is when you buy the bond, you give up some of your liquidity, but if you can trade the bond very easily, still you have the liquidity. And the reinvestment risk, as I mentioned, the coupons, you should be able to reinvest at the same rate. Not only that, you buy a 2-year bond, and on the maturity date, then you want to buy invest that cash flow, all cash flow again for another period. By that time, interest rate might have moved and you may not be able to invest at the same rate. Then the call risk and put risk. So I mentioned last week, if I remember correctly, there's an option for the issuer. Issuer can call the bonds. That means redeem the bonds before the maturity according to a given schedule agreed at the time of issuance. So that is the risk to the bondholder. A bond issued at when the interest rate is at 10%, the issuer will redeem it before maturity when the interest rate are at 5%, because he can borrow cheaply from somewhere else. No need to pay 10% interest in the future. In that instance, that's the most probable scenario. The issuer of the bond will call that bond if there's a call provision when the interest rate has moved down. Then there's a risk to the investor. Investor will get unnecessary cash flow in a unfavorable time. That means when the interest rate has gone down. That risk is called risk. That risk is called call risk. The call risk is faced by the investor as he would get the invested amount and some coupons or the interest income back in an unnecessary time, especially when the interest rate at a lower level. And the put risk, it is faced by the issuer. I mentioned last week, there's an option in some bonds to the investor. He can give it back to the issuer before maturity and ask for principal back, early redemption. If a particular bond has that option to the buyer of the bond, what he would do, if interest rate increases, he would ask the borrower to pay it early. Then the investor can invest that money at a higher rate. Then the risk is with the issuer. He has to fund that position at a higher rate. So therefore, that is the put risk. It is faced by the issuer. Call risk is faced by the investor. So those are the risks of fixed income securities briefly, but in future or next week we'll discuss this interest rate risk, duration and convexity in more details, how to calculate, how to measure, how to interpret these, and how to forecast the changes of the bond prices or the bond portfolio value next week. So we'll stop here. If you have any questions, you can ask now. By next week, be familiar with the equation, how to do the pricing, because duration is an extension of that equation. If you have any questions, you can ask. If not, we can stop here.